Welcome to Subramani. Recently, Tamil Nadu Investors Association organized an investment meet and a lot of good speakers there. Naren could not make it to that event because he was a little unwell. So he sent his recording rather than going there in person, and it's one of the best recordings of Naren that I found. There is not there is a summary of last 2-3 decades of his learning, and I'm not going to pick and choose. I'm going to cherry pick what I'm going to talk about, because there are certain things that I'm not touching upon. So first thing, Naren started by saying, don't assume that you will not make mistakes. We all will make mistakes in whichever field we are, and at the point in time when we are doing it, we won't even know whether it is a mistake. This is always a problem, because you do not know that. Let me give you an example. So sometime in 1977 to 79, 80, I invested in Reliance, HDFC, Orke, and maybe few other companies which I may not even remember. Of this, HDFC and Reliance have been brilliant. Does it mean I never sold HDFC and Reliance? I sold, because constantly you will get something saying, oh, Reliance is going to be in trouble, Reliance will not be able to pay its bondholders, Series 1, Series 2, it went up to Series 5, I think Series F rather it was called. Yes, Series F was non-convertible, and people said somehow we will convert it, right? So constantly there is going to be bad news about a promoter on whom you trust, and you do not know till you reach a stage and say, this much and no further, I am not going to sell anymore. So it took me at least say 7-8 years to realize that HDFC and Reliance are not worth selling, maybe a little more also. But till by that time I had really sold a lot, maybe I had bought back also some, right? So the need to sell was not there, but you just said, okay, my X has become 2x, 3x, 5x, so some part of the profits have to be booked. In retrospect, I can say, oh, it was a mistake, though I don't want to accept these as mistake, because on that day, on the basis of the size of my portfolio, on my ability to understand, I thought I should sell. So normally that also happens, and in retrospect you feel, oh, I shouldn't have sold, right? So also one more thing is, suppose I had bought Wipro at in 1980, and I had put 10,000 rupees in Wipro. It would be worth about 700 crores today, apart from the dividend. Now it is easy for me to say, oh, if I had bought, then I have to tell myself that I would have bought for 10,000 and held on till today. I can't believe it myself, right? Somewhere down the line, your 10 lakhs would have, your 10,000 would have become 5 lakhs, 50 lakhs, 5 crores. At some stage, you would have been tempted to sell it off, saying, okay, let me reduce the risk. Let me reduce some of the shares, right? So even if I had sold half, today it would be worth 350 crores. Then you could always say, oh my God, I wish I had it, I would have had 700 crores. So some of these could be mistakes. Some of these could be on the basis of the data that you had on that day, on your past experience. You've lost money in Silverline, you've lost money in XYZ other IT companies, and therefore you feel, oh, I wish I had kept my Wipro. The chances are you wouldn't have kept it. So some mistakes look like mistakes in retrospect, but on the basis of data that you have on that day, it would not be a mistake. I mean, everybody makes mistakes. That's what Naren says, that Buffett has also made mistakes. Of course, I have spoken to other fund managers who have made mistakes, and they admit their mistakes. So yes, all of us make mistakes. We have to accept that some are mistakes in the sense that we buy. For example, I'm biased. I do not buy companies from some cities. Most of the money that I have made are from companies based in Mumbai and based in Chennai. Maybe some little bit in Bangalore, but other than that, no, I have not made any money from a company headquartered in Ahmedabad. I've never made any money from a company headquartered in Hyderabad, right? So these are the exceptions who are there. So I mean, I'm sure there would be exceptions, but then your personal bias is not something which you can remove completely. Then Naren also says it's not the most important decisions is not what to buy, because if you are in a bear market, it is very easy, you could have bought anything. I partially agree with him, because in March to September, or March to September 2020, you knew that the market was low and it was worth buying. So whatever you bought, you would have made money, right? So in some you made 7x, in some you made 3x, in some you made 2x. But the question of, you of course made money in all the shares that you bought in that period. Now, to buy in March 2020, you should have sold in January, February 2020, and you should be sitting on cash, or somewhere you should have got a cash inflow, not from selling shares, because your shares were already down. So you couldn't have sold in March 2020, sold something and switched and made money. That could not have happened, because everything was doing well. The best thing would have been to sell gold in March, April 2020 and convert that into equity, and that would have done extremely well. You could have even bought distressed jet and made money, right? Tata Power was available at 9.5% or 9.75% interest yield, which was not bad at all, right? So many of those distressed assets you could have bought in March 2020 and made money. You made money in equity and you thought you did very well, but there would have been definitely people, I know people who bought real estate and made fantastic money, because real estate, there was a distress sale even in real estate. So some of these things will happen, some of these opportunities will present them to you, but only later on you will realize that this is what you should have bought. It is difficult, but not impossible. And also the full literature on how to buy a share, look at the balance sheet, look at the ratios, etc., etc. Very little is said about when to sell, right? So the question of buying at a cycle is right. You would have bought it in March 2020, you could have bought it in December 2008, right? Or in 2002, market was definitely well poised. Now question to ask is, did you have the cash to buy? Did you have the guts to buy? Because everybody around you was panicking. So did you have the money, and did you have the cash and the guts, and did you have a job security which said, okay, you can put so much money? Did you have the risk taking ability? All of them have to match, right? Only then will the investment be good and successful. Now for you to have so much of cash, it means if your portfolio was publicly available, January, February 2020, you would have been criticized for sitting on so much of cash. But that is the cash which got used in the month of March, right? So it's very difficult to say whether you should sit on cash, whether you should time the market. So, and when the market actually gives you an opportunity, do you have the mental, physical, financial ability to buy it? That's also a question which you have to answer. And Naren says one thing which I completely agree: due to cognitive biases, we inadvertently succumb to reverse asset allocation. We put more money in equities when equities are booming. This is true, because I've always found that when you walked into the Dalal Street thinking you will sell Reliance, somebody else will talk you out of it and say, don't sell Reliance. You end up on that day, morning you thought you're going to sell, but evening you find that you bought some shares of Reliance instead of selling, right? So getting swayed by what happens is something very common. And when everybody is buying equity, very good chance that you will also end up buying equity. What happens in my case, how I avoid cognitive biases, to look at my portfolio, and those mutual funds which are showing IRR of 36, 37 over a 3-4 year period is something which I definitely get rid of, at least partially. Let's say I have 23 lakhs lying in a fund which is giving me 36% CAGR. Right now I have seen my portfolio, and therefore, so if you have 20 lakhs, 30 lakhs lying there, why wouldn't you remove 10, 15 lakhs at least, let the SIP continue, and taking some money off the table is not a bad idea at all. Should you take that and spend on something else? That's also not a bad idea. But should you take it and buy real estate? Should you take it and buy some SGB? All these are definitely good ideas. So you can do whatever you want, but taking money off the table when you're seeing 36% CAGR or IRR is not a bad idea at all, right? So but we normally end up putting more money into the asset class which is doing well and not into an asset class which is not doing well. For example, today cash is not doing too badly, but we are seeing that in cash you will get or in ultra short bond funds you will get 6-7%, but we are convinced we will get 30% CAGR in small and mid cap for the next 30 years. So the chances are we might be tempted to put more money in small cap today, small cap and mid cap today, rather than in cash or cash equivalent, because it's no longer attractive. Debt is no longer attractive. But I will tell you how I fought my cognitive bias. Is I looked at all those schemes where I've got 36% CAGR. I took it and put some money into multi-asset fund, because that's a good way to get money out of equity into a little bit of equity, a little bit of debt, little bit of gold, and little bit of arbitrage, or whatever the combination is. Some money goes into other asset classes also, only when during a boom you remove money from equity and put it into a mixed asset class, right? Naren says it's identifying where you are in a cycle is an art. I agree with him, but I also agree with Buffett when he says when you look at a person, you know how that he's overweight or he's not overweight, right? So you don't need to know his exact weight. You don't need to know that he's got a 37 BMI or he's 96 kilos and he's 5'5", right? So you know he is overweight. You don't know exactly how much he is overweight, and therefore you can use that as a good indicator in the market to make some alterations in your portfolio. How big an alteration you make depends on how much you are worried that, oh my god, if the market actually goes up, I'll miss out. So FOMO also has to be tackled at that time, and in retrospect you know that, wow, that was fantastic time to get out. But when you are actually doing the transaction, you do not know whether you're being smart, foolish, stubborn, whatever. It's only time which tells you that you've been smart, not stubborn. Thank you.